What's up guys, welcome back to the channel, and in this video we're going to be talking about investing and particularly how you should be investing. Should you be investing with small amounts of money, or is it better to invest with a large amount of money or a lump sum all at once? And we're going to be looking at some calculations and what will happen if you either invest smaller amounts of money or if you invest a larger amount of money all at once. So with that said, be sure to stick around to the very end of this video so you can hear all about investing lump sums of money, dollar cost averaging, and how to invest to get the best returns in the stock market. Also, before we go any further in this video, I just want to give a special shout out to all my returning viewers and my subscribers. Thank you guys so much for tuning into the channel. Once again, I really appreciate all the support. And if you're new here and this is your first time seeing me, my name is Eann, and on this channel I talk about ways to make money, ways to save money, ways to invest your money, whether that's in the stock market or crypto or in a side hustle or side business. I talk about bank accounts, credit cards, and everything to do with personal finance. So if you like these videos and you like these topics, be sure to give this video a thumbs up. I'll really appreciate it. It's 100% free to give this video a thumbs up, and it helps the channel out a ton. And also consider subscribing to the channel with the notifications on. And that way you'll ensure that you never miss any of the updates when I post new videos, which is every single day on this channel. Now let's jump right back into investing. And the question is if you should invest a large sum of money at once, or should you be investing smaller amounts of money more frequently? And this also goes if you don't have a lot of money and if you can only invest smaller amounts of money. This also works if you also have a lot of money to invest. Now you could find an investment formula and do this the complex way, but I like to make things very simple. And if there's an easy way to do something, then I believe that we should do it the easy way. And so the easiest way to calculate or to see a projection of how much money you can make from investing in the stock market is to use an investment calculator. And you can get one, or you can use the one at calculator.net. And this video is not sponsored and I'm not affiliated with them, but this is just one of the first ones that pops up when you Google investment calculator. And this is the one that I usually use as well. So we'll start out with investing smaller amounts of money more frequently. And so let's say you have $100 today and you open an investment account at your favorite brokerage and you invest that $100, and you also know that you can comfortably invest $25 every single week from your paycheck. $25 every week is going to be $100 every month. So you can put $100 in for the additional contributions, and you contribute that at the end of each month. Now, some other fields in the investment calculator are going to ask you how long you'll have the investment for. And so for the purpose of this exercise, we're going to say it's going to be 45 years. Because let's say you start investing at the age of 20 and you invest until you are 65 years old. Now, I'm using 65 years because that is the average age of retirement when most people will want to pull money from their investments. And the next thing that you need to put in is the return rate. Now, this is different depending on what investments you're going to be investing in. But if you look at something like the S&P 500, over the past 30 to 50 years, it has returned on average around 8 to 10% every single year. And so we'll be using the smaller of that average, which is 8% per year. Now, of course, investments aren't guaranteed and they can fluctuate. So you may get 8% this year, you may get 50% next year, you may get 4% the next year, but usually the average is 8 to 10% over the long term. So now that we have all this information in the calculator, we can go ahead and calculate to see the projected results of this investment. And here it shows that the ending total will be $483,000, or just over $480,000, and the total contributions to this investment account over those 45 years will only be $54,000. This means that by the returns and also the power of compounding, you would have gained over $429,000 from your $54,000 investment. So if you're watching this video and you don't have a lot of money to invest and you can only invest $25 or $30 every week, I know it doesn't seem like a lot, or it's definitely not a lot of money, and you won't see any compounding or much interest or returns on your investment in the first 10 to 15 years. But after year 15, compounding really takes over, and that is when your investments start to rapidly increase in value. Now, let's look at another scenario, and this one is where you have a lot of money to invest. So let's say you have $10,000 to invest, and you invest that money and you also invested it for 45 years. You invested in the S&P 500 and you were using the very same return rate annual compounding, and the only difference is there will be no additional contributions. So if you're investing a lot of money upfront and then not small amounts of money over a long period of time, if you calculate this the very same way, you'll end up with a total of $319,000 over 45 years, and the amount that you initially invested was only $10,000. So your interest or your total returns on that investment would be over $300,000. Now, of course, if you had a lot more money to invest initially, like $100,000, you'll definitely have more money in the end. But this just goes to show that both methods of investing works, whether you invest a large sum of money up front and you let the investment grow over time, it will grow to be a significant amount of money. And even if you don't have a lot of money and all you have is $10, $15, or $20 to invest per week, as little as that seems, if you do this consistently over around 15 to 20 years, that money will grow to be a significant amount compared to what you invested from out of your pocket. Now, I'm doing this video especially to show you that you can invest with small amounts of money and you can gain a significant amount of returns on your money, because the average person doesn't have $1,000 in their checking account or doesn't have $1,000 in cash. And so I know that over $400,000 is a lot of money for the average working person right now. Now, since we know about compounding and how this all works and how much money you can make over the long term, let's now talk about dollar cost averaging. And this is when you invest small amounts of money frequently into the stock market. And let's compare this with investing a lump sum of money all at once. So based on the calculations we just did, it works out great in both ways because you can make a lot of money, but there is one danger with doing a lump sum investment. And the danger is that the stock market is very unpredictable. And even though the average return of the S&P 500, for example, is 8 to 10% per year, there are years when it dips below. And if you invest right before it dips with a lump sum or before a market crash with a lump sum, you'll have to potentially wait a very long time to break even and to see your returns or your investment in the positive. So for example, let's say you invested $10,000 1 month before the stock market crashed. This means that your investment of $10,000 would now be worth significantly less, and you'd have to wait until the market recovers to break even and see any positive returns on your investment. However, if you were to dollar cost average and invest maybe only $100 per week, whenever the market crashes, you could still be investing, and the average amount that you paid for any stocks would be less because you bought the stocks when the market was high and you also continued to buy when the market was low. Now, if you do it that way, when the market recovers, your average price paid for any stocks are much lower than the market average, which means that you end up making more money in the long term. So it's a way of always getting the best price for stocks if you want to look at it that way. Now, this is important because a lot of people try to time the market and they'll have a lump sum of money to invest and they want to wait until there is a dip or pullback or a crash in the market to invest this lump sum of money. And they want to do it this way because they want to pay as little as possible for their stocks. And that way they have a higher chance of making a lot of money when the market recovers. Now, the problem here is that the stock market is unpredictable and we never know when the stock market will crash for sure or there will be a pullback. So dollar cost averaging is just a way of making sure that you get as close to the average returns from the market as possible, which is that 8 to 10% and possibly even more when the market pulls back or has a crash. So ideally, you want to do dollar cost averaging if you don't want to risk investing at the wrong time in the stock market. But what I do personally is I dollar cost average in the market where I have a set amount of money that I invest every single week or every single month. And then I also keep some money in my brokerage account at all times. That way, if there's ever a significant pullback or crash in the market, I can take that lump sum of money and significantly lower my average price paid for any stocks and even load up on more stocks while I consistently dollar cost average into the market. So it's like getting the best of both worlds. So hopefully this video was able to answer your question on if you should invest a lump sum of money at once or should you consistently invest smaller amounts of money. And I want you guys to comment below and tell me what you think about these two methods of investing and which one you think is best. Do you think investing a lump sum of money at once is better, or do you think that dollar cost averaging is better, or do you think that possibly a mix of both is best? Comment below and let me know your thoughts. Now, if you guys are wondering what platforms you can use to invest, the one that I primarily use is M1 Finance. and I'll leave a link below to it. You can also get $50 for free by signing up and depositing $100 in your investment account. It's a very simple and easy to use platform, and I really like it. I also have links to other platforms such as Webull, which is another investment platform that I use. So be sure to check all the links down below in the description to see if there's anything that you like, and that way you guys can get some free cash or some free stocks. So with all that said, all the best with your investments. I hope you guys make a lot of money in the stock market and any other investments that you make. And remember to give this video a thumbs up and also subscribe to the channel with the notifications on. That way you'll never miss the updates when I post new videos, which is every day. As always, thanks for watching, all the best, and I'll see you guys in the next one tomorrow.